The arithmetic around government and the arithmetic around the crowding out of the private economy is something that's difficult for people to comprehend if they have normal lives.
Hmm.
But I'm going to try and make it easy for people arithmetically. And by the way, I'm going to talk about American numbers as opposed to Canadian numbers because I know the American numbers. The Internal Revenue Service estimates that the aggregate private net worth of American citizens is $141 trillion. That's what all of us Americans collectively are worth. The on balance sheet liabilities of the federal government, not including state and local governments or individual debts or corporate debts, just the federal government debt, is $36 trillion.
Hmm.
30 trillion net of the Fed's own balance sheet. So 30 trillion net debt. The difficulty is below that line. The net present value of off balance sheet liabilities, which is to say Medicare, Medicaid, Social Security, federal pensions, military pensions, the net present value of unfunded federal promises in the United States exceeds $100 trillion. So if you add the on balance sheet liabilities, 30 trillion, to the off balance sheet liabilities, 100 trillion, and you subtract that to the net worth, the private net worth of Americans at $141 trillion, you only have $11 trillion left over. The on balance sheet deficits increase by $2 trillion a year, meaning that you use up the net worth of Americans in 5 years. But the off balance sheet liabilities also increase by $2 trillion a year. This is problematic. I don't believe, arithmetically, that there is any way that we can service our obligations, our entitlement obligations. The upshot of that for investors, where the rubber meets the road, is that I believe that we will have to allow the purchasing power of the US dollar to decline so that we can honor our nominal debts while not honoring our real debts.
Hmm.
We did that in the United States in the decade of the 1970s. In the 1970s, according to the Congressional Budget Office, the purchasing power of the US dollar declined by 75%, not relative to other currencies, but in an absolute sense. And I believe because of this $100 trillion in unfunded entitlement liabilities, that the US dollar will lose 75% of its purchasing power over 10 years. This is a crisis that we'll get through, just like we got through the decade of the 70s. But it's a crisis that will require preparation for people. And I suspect that they start planning for that, both in terms of how they save and in terms of what their expectations are for their retirement. I think people need to plan right now.
Yeah, a little bit late to the party if you're just waking up to it. I mean, it feels as though people are talking about debasement a little bit more now in this macro environment. And I mean, you've said that we're entering this new era of volatility after decades of relative, macro stability, if you will. I mean, the markets have been they've been crazy, if you, right? I mean, what's changed since the 1980s? How should investors kind of shift their mindset to survive and to profit from it?
Well, you make a great point. After the 70s, we had some moments of fiscal sanity in the late 70s and the early 80s. The size of the federal government never never shrank, but it grew less rapidly. And we had real interest rates that were very, very, very high. We rewarded savers as opposed to spenders for a while. And that broke the back of inflation. We had a period, 1982 to 2022, that from an American point of view was pretty close to perfect. Declining real interest rates, declining nominal interest rates, a very strong US dollar, an influx of foreign direct investment. Americans were able to export their inflation to other countries through monetary policy. Equity markets responded to declining real interest rates by booming. My suspicion is that began to end in 2022 because that benign economic climate in the United States allowed us to take our aggregate federal debt relative to GDP from 30% in 1981 all the way up to 120% today. In other words, we went from being a country that had its obligations in pretty good balance in 1981 to a country where the obligations are wildly out of balance today. I need to say one more thing. At the top of the interview, you described inflation the way most people think of inflation. Most people think of inflation as inflation measured by the CPI, the Consumer Price Index. I might point out to you that whoever compiles the CPI doesn't shop where you and I shop. Common sense will tell your viewers, if they think about the cost of their own living in the period 2020 to 2025, that the idea that the CPI measures the deterioration in your purchasing power is farcical. First of all, the CPI doesn't measure tax. I guess for people who don't pay tax, that index could be partially valid. But look back at gasoline prices in 2020. Look at food prices in 2020. If you're American, look at healthcare costs or healthcare insurance costs. Look at rents. Look at mortgage payments. The truth is, I believe that the purchasing power denominated in U.S. dollars is declining by more like 7.5% or 8% a year, not 2.5%. And for Canadians, over the last decade, it's been worse, not better. So if you are looking at the CPI number as a gauge of the deterioration of the purchasing power of your savings, you are wrong. You need to understand that the purchasing power of your fiat-denominated savings is declining at more like 7.5% or 8%. That means that if you buy a U.S. 10-year Treasury yielding 4.5%, that rather than making the difference between 4.5% and 2.5% or 2% real yield, you are actually losing more like 3.5% or 4% a year compounded. You need to change the way that you think. You need to change the way that you plan. You need to change the way that you spend, and you need to change the way that you invest.
Yeah, well said. Not to mention, every single time we cover those official data points, we get revisions, a couple months after anyway. Okay, well, we got to shift to hard assets and what that means then, because it almost feels like we're in this capital rotation away from consumption and into those hard assets. But I'm curious, why are growth stocks like NVIDIA and still out, they're attracting these outsized inflows? I mean, gold ETFs saw $2.8 billion in outflows in May. So, I mean, is the market still chasing, quick upside over long-term protection?
I think two things. Well, the system probably isn't solvent in the long term. The system's highly liquid. There's a lot of cash in the system. There's a difference between liquidity and solvency. Solvency matters in the near term. Liquidity matters in the near term. Solvency matters in the long term. But the second thing is these big tech companies are really good businesses. I don't invest in them because I don't understand them, but I understand a lot about profit margins, and I love Apple's profit margin. I love NVIDIA's profit margin. Investors who maybe pay less attention to balance sheets and income statements than I do just look at the fact that the tech trade has worked for 40 years. It's difficult to change people's perception. I think if you asked a lot of viewers on your show what they expected NVIDIA's earnings to be like 5 years from now and what they thought about NVIDIA's technology relative to their competitors' technology, they would probably look at you askance and say the stock's going to go up. Those are very, very, very different investing stratagems. Yeah. I'm not criticizing technology investing, by the way. I'm just saying that because I don't understand the intricacies of the technology, I don't invest in technology stocks. Others, I suspect, who know as little or even less than I, invest in them simply because they've gone up for 40 years.